What's up, guys? I'm Nobody Special, and I am here with Bob Coleman. He is the CEO of Idaho Armored Vaults. We're going to talk about one of my favorite subjects, gold and silver, today, and just what in the world is going on with this big rally in gold. Now, Bob, we had a heck of a day today. It's Friday evening as we're talking here when we're recording this, and we are just coming off of the price smash that we've all been expecting. It finally showed up today. It was a lot of volatility in precious metals. Uh, what happened today and on Friday? What was this big dip that we saw, in your opinion?
Well, I was hoping you could tell me. I'm just kidding. Now this has been a culmination, like you said. We got stretched to the upside. You had basically in social media. I mean, the sentiment was probably above 100 on a zero to 100 chart. I mean, there's a lot of euphoria. Basically, you saw macro economists that never even talked about gold becoming the experts and go to about telling everybody where gold's going, why is it moving. And most of these guys are just simply, they're just technicians or strategists or like macro analysts. They're not, they don't live and breathe the gold world, so to speak. So um, everyone became an expert overnight. And I think what's happened, you look at gold volatility that blew out to the upside. So you got extended in a lot of different areas. The option activity has been incredible. You got to remember too, gold and silver, the CME has now gone to daily expirations on their gold and silver contracts on the option side. So that adds even to more volatility as well. And then you combine that with, you saw short squeezes basically popping up in a lot of the mining stocks, a lot of some of the precious metal affiliate type of companies out there that are in the business of buying and selling metals. And then, of course, you saw a big run up in gold and silver as well. And I think you just like you said, you needed to see some type of profit taking. The problem in our business, especially for people that haven't been through this in the last, over the last 20 years, for example, is it gets choppy. Especially when you get to an overbought status, when those pullbacks come, they can be absolutely vicious. And I think this is basically what we just saw. The ship was kind of tilted to too much to one side going into today. You look at the commitment of traders reports and how long managed money was going in as of Tuesday of this week. They were very long. Commercials were actually very short. And there was just basically a kind of a reversal and all that leverage. You got to remember, dealing with futures contracts, everybody's on leverage. So you have this sort of magnified effect, when you get an outside move, um, you know, profit taking ensues, because you got to remember, most people that are on leverage, they're what they call weak hands. They can't, they don't take the volatility. Their idea is to trade for the profit, and so they're very quick to get in, and then also very quick to get out.
So it sounds like routine profit taking is kind of what we saw here. A lot of guys were out on leverage. They decided to take profits when they could. They saw it start to drop. That triggered a little bit of a wave of selling. Um, and it's interesting because we're talking almost exactly the level, like within a couple of cents of February 1st of 2021 with the silver squeeze, right? Right. It was 28 and change, was right about that level that we peaked at when we saw that big red candle down. So I think a lot of people were rolling eyes at what was happening. But this rally in gold particular and silver, it looks very different than the lead up to silver squeeze and the immediate aftermath of the silver squeeze. And I want to ask you a few questions about some of the things that I see that are a little bit different. The first thing I hear a lot about is the flow of metal from west to east. I hear a lot about China's buying all the gold now. And, when you hear China, it's not just China. You got really a lot of Asian economies are buying gold now. A lot of central banks around the world are buying gold. Do you see, is that the driving force behind this rally, or is that just one of many contributors that you think are driving this?
Yeah, it's one of many contributors. It's funny that you mentioned that, because back in 2021, the mantra then was Chinese housewives buying gold. Um, and that's what was driving the market. I think you have, there's obviously been a lot of physical activity going into India, China the last couple of months. I think that's sort of woken up this crowd in terms of uh, European investment houses started to see flows coming into their ETFs. Wisdom Tree, for example, saw their ETF jump literally 50% in size in one day in March, and you saw the iShares physical fund, silver fund out of Ireland that took in I think 8 or 9 million. Or created 8 or 9 million shares in one day as well. So you saw sort of this shift where institutions were saying, "Listen, I missed the gold trade. Um, I got silver still, and that thing is not anywhere near an all-time high." So you started to see this shift going back, looking at silver from the gold silver ratio, or maybe relative value, to gold, or relative value to the S&P or to other types of matrices that they may be using. But I think there was this in March. There was this openness by institutions and high net worth individuals to say, "Listen, maybe it's time to reallocate. The stock market's at been blown out through the roof. The crypto's gone straight up. Maybe I should now reallocate a little bit to commodities. Silver, gold, whatever it may be, the precious metals. They look pretty decent here, and on the charts are finally getting some activity. And I think that kind of compounded too. So it wasn't just Chinese buyers. A lot of high net worth, maybe ultra high net worth individuals saying, "Listen, you know, I don't know where the election's going. I don't know all the spending, Yellen spending what $1 trillion every 100 days, whatever it may be. This idea that I got to be concerned about the future of the currency, the future of stability in not only the dollar but the debt servicing of treasuries. Not that the treasury is going to have a problem servicing their debt because they can always print money, but it's the idea that how much of that is going to be starting to compound more inflation and more fiscal spending into this economy, increasing that cost of living, which then destabilizes confidence, and that's ultimately what starts to drive the metals. I mean, it's kind of funny because whenever gold and silver start to get moving and break out, that seems like when the party's over for the general markets. I think that's where they say, okay, we draw the line here. We got to stop this, before things get really out of hand. But that's the notion that the metals, I think it's the barometer that of sort of tension that you kind of see in the price that you may not be able to chart just normally with other types of indices and things like that.
Clarify for me the demand that we're seeing from Asia. Is this paper demand? Is this funds trading back and forth and arbitrage with the futures? Are we actually seeing metal on boats or metal on planes heading east?
Yeah, there's physical demand. There's no question about it. You can look at the export data from Switzerland, as well as from London. So there is real metal that's moving. You saw real metal imports going into India, especially the first 2 months of this year. I think those 2 months, the import demand from India was greater than I think in the U.S. all of last year. I mean, it's an incredible amount of, and that had to do with a little bit of um, some legal or law changes in customs duties of silver going into private hands into India. Actually, funny thing is bypassing the banks, going onto their exchange, and so it allowed them. I think the tariff rate was actually a couple percentage points cheaper. And all it took was just a couple percentage points cheaper on tariffs, and all of a sudden you get this open floodgate of silver demand going into India. But that's sometimes you just don't know what's going to turn on the buyer to get off the couch. What starts to increase that flow or a capital flow of money coming into the sector. I think it's just I think that the metals in February saw such dim expectations. The sentiment was so poor. I mean, it was just you look at social media and people were just it didn't matter what you own. If it had gold and silver associated with it, it was just, people were just in complete shock. And so I think when we kind of mixed all that together, and then you took the managed money crowd, they were $1 billion net short notional silver. That only happened, I think, 5% of the time. If you look at the entire history of the Commitment of Traders reports, that's what kind of made me sit up and say, listen, I think it was mid-February, I came out with this idea they posted as the mother of all short squeezes, because what happens in a bull market, and for example, a short squeeze develops, is you have players that are caught on the wrong side, but you start to see you have to see a number of events kind of take hold here, and part of that is the retail crowd isn't a believer in that asset. They're fighting the rally. They're like, this can't go, this can't keep going up. This is going to be killed. It's going to go down, and then it starts to rise a little bit more. And now all of a sudden, the retail is starting to sell into it. They're saying, at $25 silver, $24 silver, like, okay, it's going to go up, but it's going to probably trade right back down to 22 because it's been caught in this range for the last 2 years, hasn't gone anywhere. Well, then all of a sudden the metal starts to go a little bit higher, and you start to see even more selling. And this is where you look at retail dealer situations and the wholesalers, and they were seeing huge um, balance sheet exposure with regard to sitting on a lot of inventory, a lot of overhang, a lot of burning cash and expenses of carrying that inventory. And then of course they're sitting on all that inventory. If they're a lot of people in the industry will actually hedge, so they don't have the price risk. Well, now they're shorting futures contracts against physical inventory that's not being bought, and that's actually continually compounding and getting larger. And so they were short futures contracts. The prices are going up. They have to now pony up more money to cover that hedge, that short that's actually going underwater. And then all of a sudden lo and behold, a couple weeks ago, you had the CME raise margin requirements, which makes it even more expensive to hold a futures contract. So that if you're caught, initially you had a big plunge in the market when that happened, and then you had a reversal back up. And so you got to remember, if the shorts are their cost of holding a contract goes up just as much as a long does. And so if the price doesn't start coming down, but actually starts rising again, that creates more pressure on their margins as well. So then they got to either pony up more money or cover the position.
So that's a pretty stark contrast to what we saw in 2021 with the silver squeeze. The situation you're describing right now seems like tightness in the paper market, and yet we're not seeing high premiums when we go online. If you look at an APMEX, a JM Bullion, any of the dealers, we're not seeing a blowout in premiums. Whereas February of 2021, you couldn't find physical anywhere. The premiums were $10, $15 over spot. Now it's for silver. Gold was what? I don't know, $50, $100 above spot they were charging for physical metal during the squeeze. And yet there was just massive paper supplies being dumped. So at risk of sounding cliche, and it's different this time, we're seeing a pretty stark contrast here. What's your impression of the physical market and the premiums and the inventories? Is that problem still as severe as it was a few months ago? We talked about that at the Silver Symposium, and you've mentioned it on Twitter a few times. Are you seeing any easing, if you will, in the physical market? Are the premiums starting to move up? Are the dealer inventories starting to come down, or is that pretty much still tight over there?
I think some of the inventories have come down a little bit. It really depends on product. Silver Eagles, for example, is very popular. The premiums have actually been rising on the wholesale market. But again, that's not necessarily what you think it is. It's really big. And we'll get to it's different this time in a second, because I'll explain to you how it's not different this time. But the Silver Eagle premiums are going up, and it's because the U.S. Mint production schedule is such that they reduce production. They're going biweekly, so you have this sort of tightness in the market with Silver Eagles, and it's a very popular product, and so that's usually the first product that's usually chosen by the typical retail investor. And that's because of multiple reasons. If you live in a state, that Silver Eagle may be capital gains state tax free if you live in certain states. So there's some benefits to the Silver Eagles that you may not have with other products. Um, But if you look at other products, 100-ounce bars, rounds, there's a lot of inventory. Some of the sovereign coins, there's a lot of inventory out there that dealers are sitting on, trying to move. And that's something that when you say it's the idea of, well, how is it different from 2021? The biggest difference right now is that I think the public realizes how much they overpaid for metals, especially now they're seeing the bids on these products, at $1 to $1.50 under spot, by major retail dealers that were selling that same product for $5, $6, $7 over spot during the silver squeeze. When I was back then, I was trying to yell at the rooftops that people are overpaying for metal. They need to be shopping around. Don't listen to all the hype. The idea of shortages in the market. It wasn't shortages. It was just tightness. There was a lot of salesmanship, fear mongering, profiteering going on, not only by the retail dealer but also by the wholesale community too. Well, you don't have the pricing power. The retail dealer industry doesn't have that pricing power right now. Otherwise, they would probably be trying to lift premiums in this type of market with the hype of gold breaking out and silver kind of back to the 2021 highs. Just as a side note on the 2021 number, because you mentioned it came in with a few cents of the high of the silver squeeze. When you see this pullback, a lot of times technical guys, traders will see this sort of idea of a double top where it revisits, a previous high, stalls there and pulls back. So there's this old saying, you see a double top, you sell a double top. You have that type of chart action. That doesn't necessarily mean the metals have topped and going down forever now. You just have technical action amongst the trading side of Wall Street that just tries to say, listen, it's time to take some profit. And they try to capitalize on maybe a chart formation. But if you look at the longer term picture of the metals, they're building this continual inverted head and shoulders sort of higher lows and eventually higher highs, but you're seeing the very similar chart action. We talked about this at the Silver Symposium, a very similar chart action to 2008, 2009 into 2011. And that's where this idea that we may not have seen anything yet. I mean, the idea of, it's like I kind of mentioned today. Now I know what it felt like this morning we came in and I said, now I know what it feels like to own Bitcoin. When it's moving up and going straight through the upper Bollinger Band line, getting overextended and staying there. But I think the analogy of a short squeeze would be, you get these violent moves down, scares the public from jumping in. They sit on the sidelines. They're like, okay, this thing's going to pull back hard now. Now the question is, how much back and fill action will we get, and will it start to stabilize and go sideways and build for the next wave? That's what you're trying to watch for in a true bullish market that's ultimately going to squeeze people a lot higher, because you're going to bring in a lot of this short interest that's saying, okay, that was it, time for the crash.
Along the lines of, once again, the cliched, it's different this time, and you can feel free to burst my different this time bubble anytime you want. You've had a lot of tweets about the ETFs recently, and in particular, this one from just yesterday, actually, I'm going to read it to you here. Short sale volume continues to be highly elevated, 6.5 million shares today. We're referring to the SLV here, with short volume ratio near highs of the year at 72.95. What makes this interesting is that 4.45 million shares have been redeemed for physical metal at a time when short sale volume is staying strong. In other words, less shares outstanding while seeing more short activity. Correct me if I'm wrong. We've got big money, the authorized participants, it sounds like they're buying SLV shares, redeeming it for the physical metal. At the same time, you've got somebody, I don't know if it's the same players or whoever, but somebody is short the ETF, keeping that price lower. Seems different than what was happening with the ETFs, which were absorbing demand on paper while not affecting the demand for physical supply back in 2021. What's happening with the ETFs right now? This seems a little strange.
It is, and this gets maybe a little bit technical, so we'll kind of walk through it. When you're talking short volume, some of that activity is market maker activity, and so part of the frustration, I think, a lot of physical metal owners, when they look at the paper markets and they say, "My God, it's manipulated. It's being heavily managed by the paper markets." Well, part of that is the market maker system. It's the way how they can absorb flow, like a sponge. Think of it that way. So if you start to see a big wave of buying coming into the market makers can go naked short and sell shares they don't have, to meet that demand, to absorb that flow. And then at some point, being now this is because they're an ETF, they have the ability, if they have silver, for example, in their vault, they can then take the silver in the vault, bring it over to the ETF and say, listen, I want to create shares. Here's the silver. You give me the shares, and I can create and I can reduce the net short position that I have. Basically, I can use those created shares against the short book that I have. So, if that kind of helps you a little bit there, that's part of what kind of happens here. But what I find interesting is that percentage of short volume activity, because there's people that have been DMing me saying, listen, the short volume includes the buying back or the covering of that short that was originally made. So that adds into the short volume. But what I try to look at is the percentage of short volume. And if you look at that, what you just had mentioned there, it was very one-sided. It was like 74% of the entire of that volume, the total volume, 74% of that was short volume. So it wasn't just simply a one-for-one relationship. It was biased more on the short side. So this is where, when you get into the market makers, when they get very, if they do have a very big net short position, for example, yeah, they'll do that. I mean, they're in the game basically to be net neutral or to make money on spreads. But if they get into a position where they have, they've sold too much because people are buying, part of the high short volume as well is also it's saying that there's a lot of demand for, that particular issuance, whether it's SLV or spiders or whatever it may be. But what's happening is when you get to overbought levels, and these market makers have a lot more power than you think, and they can influence markets. They can, because as they're absorbing that flow that would have potentially went to actual physical metal and had to create, the authorized participants would have had to go create more shares to then deliver into the SLV, which you would have seen maybe more tightness in the silver market because of that. You weren't seeing that. They were meeting that demand with selling stock. And what's interesting is when you started to see flows of silver coming out at the same time short volume was staying high, that's even more perplexing, because you would think, well, that's going to create potentially, more of a squeeze type of phenomena that could start to happen, unless you have a big whack in the market where they can now start covering, buying back a lot of the shares that they had basically shorted at a higher price.
That's interesting. So the redemption of the metal in the ETF, which results in fewer shares in existence of the ETFs, while at the same time you have the high short interest, you're right. That's reducing the liquidity of shares available. So you actually could end up in more of a squeeze scenario where the price of those shares starts to rally relative to the net asset value. Interesting. So again, not something we saw in 21, was it? So why is it not different this time? What's similar? Why do you think we might be in the same situation?
The problem we had in 2021 was you had a lot of new players into the market. You had, the COVID situation, the money flowing like with the creation of all these government programs and the Fed expanding the balance sheet, but you had a lot of also, unfortunately, a lot of questionable actors out there promoting, whether it be metals or crypto or whatever it may be. There was a lot of FOMO. There was a lot of fear mongering. There was a lot of sort of gamesmanship that was going on to try and get the retail investor really revved up into the asset class. And the problem that you had back then was the retail investor was investing a lot of money into the metals, but a lot of that premium was just pure unadulterated profit. I mean, you're talking hundreds of millions of dollars, if not billions of dollars, of profits that were overcharged to consumers that could have actually went to buy more metal, to be honest with you. And I think you would have had a lot different scenario unfold. Whereas in today's world, a lot of the demand that you've been seeing has been more on the 1,000 ounce bar side. That's more sort of lower premium type stuff, but it actually it's the bar that for silver, for example, it's the item that affects a lot of these matrices, like the exchange for physical premium, and a lot of these spreads, and everything is kind of fine tuned on that 1,000 ounce bar, because that's used in from fabrication. It's used for ETF purchases, institutional ownership. There's a lot of bigger money that's wrapped up in that product, not necessarily silver eagles, for example. And so it's just a shift in product demand. Instead of going into 1 ounce rounds, for example, and paying $4 over spot or $8 over spot, that a lot of these online dealers were charging 3 years ago. You're seeing that demand shift to lower premium product that says, listen, and especially now that you saw how volatile the spreads are on a lot of these physical products, people are saying, why should I? Let me give a chance into the whether it be the paper markets, whether it be 0 date expiration options markets. I mean, you have more vehicles today than I think you had in 2021 from a standpoint of leverage. And you're starting to see it creep up again in open interest in futures contracts, especially, as well as volume as well. So those are things that are very, that I think are similar in terms of activities. It's just that the money is just being refocused to this going more toward more metal per se than more premium.
Yeah, whereas the premium just absorbs dollar liquidity in the market and it doesn't really affect the supply demand dynamics of the underlying metal. Right now, most of the price action is around these 1,000 ounce bars where the premium plays a much smaller role. And so you're actually affecting the supply, the inventory of the metal more directly.
Yeah, and we saw evidence of this in March. When you walked into the February, at the end of February, when silver March contract was coming to expiration, you go into the May roll from the March contract was the lead month, and then it goes to the May contract. Well, when you had that switch to the May contract, an interesting phenomena was taking place where the exchange for physical premium, that's the difference between London spot price and the lead month New York COMEX futures contract. It's the difference in the spread between those two prices. That spread typically declines to zero as you get closer and closer to the expiration of the COMEX contract, because a month or two out, you have interest rates, you have cost of carry, you have a reason for that premium to be higher than the day of expiration, very similar to an options contract. So, but what you were seeing is, you normally each day, the exchange for physical premium, which is a spread trade, it typically starts to decline a little bit each day as you get closer and closer to expiration. But what you saw for about 3 weeks, 2 or 3 weeks, is that silver, the EFP, wasn't moving. It was actually staying very strong, and that was telling me that somebody was caught short on the paper side, because if the exchange for physical premiums rising, that's usually telling me the futures leg of that trade is actually going up. If it was the opposite, if it was the physical side of the trade, London side of the trade was going up, you'd have more what they call backwardation, because then the physical becomes more expensive per se than to the futures market. But in this instance, it was just the exact opposite. And so you were seeing this demand for on the paper side, and that was partially due to the massive short position by CTAs on silver, for example, that they had to unwind and start to buy back and cover, and maybe shift their position to going that long. these are things that I watch, and that's what I try to report on Twitter wise. But the problem is, it's like my clients tell me you got to put on a decoder ring to read some of my material. But that's sort of what I started to see unfold, and that created an interesting environment, because at the time when you saw the shift occurring in the futures markets, the retail guy was like, I don't ever want to touch this stuff again, put it all into the Bitcoin ETF. This is, metals are the worst thing in the world. The miners are the only thing that's second to the metals. And it's like, and you just had complete despair. While underneath the surface, you saw actual change forming and taking place and firming up the markets, and that's some of that stuff was what I try to focus on, as because you have to remember, just for your listeners, I run a hedge fund in physical metals as well, and so part of my job as a portfolio manager is to watch the sort of intricacies of the markets.
So that retail reluctance that we saw in February, which is, retail is usually the last guy on the ship, right? He's the last one to pile in before the bottom falls out. We didn't see that in February, still had room to run. In your opinion, are you still seeing that retail reluctance? I know things started to get a little frothy today, and then of course the price got smashed down again. Do you have you, in your opinion, have we seen that retail jumping on the ship yet?
No, I mean, you see it with larger investors. I've been hearing from other dealers, and wholesalers, that the size of the trade has been bigger, and so that's helped absorb some of the selling that's been coming back to them. They've been able to maybe match the trade, so to speak, or cross the trade. But you're not seeing, the retail guy, uh, FOMO, basically saying, I'm all in here, just get me in at any price. You're not really seeing that like you did in 2021. And I think part of that is, I think people have been burned so bad, and that's the frustration that I had with the industry back then. Was you're when you're charging as much as you are for a product, you're people are going to end up realizing that they overpaid for it, and it's going to put a sour taste in their mouth, and they're probably not going to come back. And then that's why the last 6 months you started to see a pickup in selling, where people are like, the stock market isn't crashing. These gold dealers and promoters that were telling us the end of the world was coming, and that the bonds were going to go break to zero, and the interest rates were going to fly, and the dollar is going to zero, and the real estate market's going to crash. And it never took hold. I mean, the stock market went up, it went to new all-time highs. The bonds didn't break down, the dollar didn't crash, and interest rates were now a very big competitor to gold, and silver, because it was paying 5+% on the T-bills. So you had that, where people are like, listen, and you got to remember too, people that bought metal back in 2010, 11, 12, 13, there were three times as many silver eagles being made then than there was in 2020, 21, 22. So there's a lot of overhead supply and a lot of lifestyle changes that take place during this type of environment, where someone that bought, maybe when they were in their 50s, 15 years ago, their lifestyle completely changes. They don't have the time to wait for the metals to go to $50 an ounce, if it's even going to go there, for example. But they need income. They need to be able to turn this asset into something that is going to pay them on a monthly basis. So you've seen that sort of frustration of getting out, and the oddity about all this is that people have lost a lot of faith in the metals the last few months, at a time when you couldn't write a better script, for the base that had been building. And this, it's almost like, and it just, I don't know what it is about the metals, but they tend to move when you least expect it. And this is exactly what we basically saw. Was you got to the point where people were throwing in the towel, and that turned out to be the bottom.
Now that's a perfect lead into the next question. Metals move when you least expect it, because look what we're seeing right now. Metals up. I think Kobayashi Letter had a pretty good summary written this morning. Gold is up 30% in 6 months, and yet over that same 6 months, We have seen all-time highs in risk assets, right? Tech stocks, cryptos. We've seen 4 rate cuts priced out of expectations for 2024. We've seen interest rates head higher, and we have seen the dollar strengthen. These are all things that are supposed to be kryptonite for the gold price. And here is gold and here is silver rallying in the face of all of these headwinds. So I know there's a lot of people out there scratching their heads saying, how is this possible? What does gold see? I hear a lot of people are saying gold sees something, right? Why are these historical correlations breaking down right now? Is it one thing? Is it a combination of things? What do you think is the biggest driver of that?
Well, I should say first, now that gold and silver are going up, I guess the party's over. So for all the other assets and maybe the general market, who knows? But I think gold, it's sort of this, this rising tide lifts all boats scenario. There's been so much money thrown in terms of fiscal spending by the government. Everyone knows, Yellen is being extremely supportive of the economic climate. But especially with the election year, they're going to try and paint the economy with the best brush possible, try to keep asset prices as high as possible, because we've got to remember, no one's going to riot, when their 401ks at all-time highs. And you're not going to shift probably your voting habits if you're feeling wealthy and rich. So that's that wealth effect as well. Part of it too is obviously taxation issues, tax revenue. At higher the more asset prices go, if people take profits, that's going to be more tax revenue for the government. So there's multiple things that kind of get thrown into that. But I think for the metals, I think there's a real true question here that gold is probably saying, how much more can the government or the central banks, sort of continue this monetary support without, with this idea that they think inflation is just going to go back magically to 2%. And I think it's this idea that, there's been so much spending going on, and I think there's been so much talk and support, a lot of supportive factors by officials out there, that gold's finally said, listen, enough's enough. They're not going to raise rates. They're not going to fight inflation. This is the election year. They're not going to probably do anything that's going to try and harm the markets until maybe after the election. And maybe gold is telling us that, basically keeping it simple, is that they're just going to continue to try to be supportive of the markets, no matter what comes at them, in front of that election. And that's the oddity. Gold's one of those assets that, 6 months after the move happens, then it's the aha moment. And that's when we finally realize, well, God, why didn't I see that? But that's just how markets move. They disguise themselves. A bull market is designed to buck you off as much as possible during that move up. Otherwise, I keep saying to people, the monthly charts, when people show these monthly charts, it's like, oh God, that's easy. I should have just held that, and I could have sold it right there and bought it right there because the chart's nice and smooth. But you dial that in on a magnifying glass and you see some serious volatility. It's not as easy as it sounds. And that's one of the things, is if everyone could do it, they'd be rich type of thing. That's the anatomy of a bull market. It really is difficult to hold through. And that's why I think, this type of rockiness that we're seeing in the market, these sharp drops, if they're sharp but somewhat short in nature, it's telling you that there's a lot of underlying support behind this market.
Well, Bob, I want to thank you for weighing in on that and for offering your wisdom with us. You may have noticed my lights flickering in the background here. We've got thunderstorms approaching, and the power grid in my area is notoriously unreliable. So I think we're going to call it here. Now, where can my viewers follow you, Bob? Because your updates, especially on Twitter, that tweet that you had back in February, man, that was right on the money. You nailed this call about this bull run. So where can people follow you so they catch the next one?
Yeah, I mean, I'm on our website, goldsilvervault.com is our website for our depository. I have articles on there as well. We run one of the largest private depositories in the United States for precious metals. On Twitter, or X, I guess you call it, my handle is Profits Plus ID. That's PROFITS PLUS ID, as in Idaho. I put out a lot of information there, and of course, I do podcasts and interviews and things like that. that. But yeah, it's, I try to keep it simple. I try to help educate people. I'm not one. I don't like the speculation and conspiracy and try to fear monger. That's not really my style. I like to try to be positive and informative to help people make decisions that are best for them. It's just my nature.
Well, I'll tell you, you were willing to speak out during the silver squeeze. You told people things they didn't want to hear. You caught a lot of flack for it. So I'll give you credit for that because you ended up being right. And then you nailed this call back in February saying, hey, the setup for silver is just a monster right here at a time when a lot of people were very bearish metal. So that's two really good calls you got there. Folks, check out Bob's X feed or his Twitter feed and his website. Worth the time. Bob has forgotten more about the precious metals trade than most of us could ever hope to learn in 2 lifetimes. So I highly recommend that one. Bob, thanks again for your time today, for talking to us, and everybody else. Until next time, live small and dream big.
Thank you, Jack.